Okay, good afternoon. We'll go ahead and get started here for our noon webinar, our advanced IC disc for manufacturers and distributors and increasing intended and allowable IC disc savings for manufacturers and distributors. Okay, so just a quick bit of background on our firm and myself. We're all part of a leadership team, at least, and most of our firm is folks that work on a national export incentive team, did IC discs, and for those of you that remember FISCs and ETI exclusions, other export incentives in the past, those were good for public companies as well. Back up through 2006, they provided permanent benefits for public companies. So again, we were part of a national team, much like all the big four had, that really focused on those incentives and other quantitative matters. Our firm, we do a lot of work with maximizing disc benefits using proprietary software, which you really need for the proper compliance and the proper calculation in many cases. That I shouldn't say proper, but the optimized calculation. We partner with all kinds of CPA firms all around the country, all sizes, just from sole practitioners to we have clients of even big four firms where we do the disc work for. And we don't practice in any other area but the IC disc. I'm one of the co-founders of Quantitax and have been working with export incentives for a quarter century now, including IC disc, and primarily I would say IC disc now. So it's just a little bit of background on who we are and who I am. So I apologize for those folks that were with us yesterday. We'll try to add some different color and different examples as we go through sort of some of the basics in the disc. This is an advanced course talking about maximizing allowable benefits and ways to do that, and some of the associated compliance and green flags and red flags and all that kind of stuff. But we will review a little bit of just basic IC disc before we dive into those items based on optimizing the calculation. So for those who are new, Interest Charge Domestic International Sales Corporation, been around since 1971 in one form or another. It's to encourage foreign use of goods that are at least partially produced in the U.S. It is an annual benefit and intended by Congress to be a paper entity, basically to help U.S. entities compete outside the U.S. and encourage U.S. production, growth and extraction, farming, all that good stuff in the United States. So that is the congressional intent of the IC disc and other export incentives that have been phased out or have been Congress has decided to discontinue due to pressure from some of our trade partners that don't look on the incentives very kindly. So who can benefit? Private companies that make or sell things that are at least partially produced in the U.S. and that are ultimately used outside the U.S. or consumed, ultimate disposition outside the U.S. It does not need to be an exporter. As far as the benefit profile, you don't need to be an exporter to benefit. Certainly you can be an exporter to benefit, but as long as you're involved with the sale or lease or license of these products that are partially U.S. produced, again, you don't have to be the one producing them. You can potentially get a benefit. One thing to note is that in order to benefit, there's generally got to be a tax liability at the 1040 or 1040 NR, the individual taxpayer level of the owners of these the private companies that have eligible sales for the IC disc. The way it works mechanically, typically, you have an operating company that pays a deductible commission that would otherwise be taxed at top ordinary rates, or sorry, at ordinary rates that top out at 40.8% when we include the net investment income tax. To the IC disc entity, there is a separate entity involved for those who are new to this, but again, we're going to breeze through this a lot quicker than yesterday because we have more advanced material to talk about, but which is designed by Congress to pay no tax and simply receive a commission for either serving as a commission agent for the operating company that has these eligible sales, or for just existing as an IC disc, simply being set up as an IC disc entity, which is a tax-exempt entity, will enable a receipt of that commission from the operating company. The DISC then typically, go forward to slide 9 here, typically the DISC will then return to the operating company, that's our green arrow here, the money as a dividend. This is probably the way 95% of DISCs are set up. Again, operating company pays a subsidiary DISC a commission based on how much qualified sales activity and income on that activity it has. We'll get into all the different ways to maximize that commission, but at a minimum, it can be 50% of the the taxable income from those qualified sales. It can be paid from the operating company to the IC DISC. So that's what we're talking about here when we say the IC DISC returns that commission typically as a dividend to the shareholders. So they're taxed on the same amount, but only taxed at the dividend rate, which tops out, including the Obamacare net investment income tax at 23.8%. So this is how a subsidiary DISC works. Again, skipping forward to the slide here. So we've got an operating company that has eligible sales and it pays a commission. Let's say it has $1 million of net taxable profits from qualified sales that are, again, at least partially produced in the U.S. that end up outside the U.S. So at a bare minimum, at least half of that, or $500,000 in this example, would be able to be paid from the operating company to the DISC, which receives it as tax-exempt income as designed by statute and as intended by Congress, and pays the dividend right back to the operating company. So important to note that in this example where we're dealing with an S Corp or a partnership, which is again probably 95% of IC DISCs out there, the income for the operating company stays exactly the same, right down to the penny, with or without the IC DISC, but whatever amount is exchanged with the red and green arrows reaches the individuals on their Ks as dividend income. So let's say these individual owners, just for simplicity's sake, we'll say there's just one. In this example, would normally receive a K1 from the company for $1 million for the company's profits that flow through on all of its activity. But in this example, remember, we were able to all of it was qualified activity, so we're able to pay $500,000, 50% of that back and forth. So the individual still receive a K for $1 million, but now it'll be $500,000 of ordinary income and $500,000 of dividend income, and that's where the savings is at that individual level. So how much can that commission be? Commission can be at least 4% of eligible sales or 50% of the eligible taxable income from those sales. This 4% of eligible sales number is capped by 100% of the taxable income when you use this basic method. So there is that sort of limitation on the 4% method. But mistakenly, a lot of folks, attorneys, accountants believe that 4% or 50% is the maximum amount of commission that you can have. But as our focus is today, we're going to talk about how that amount can be much, much, much more. With a commission DISC, business operations are generally not affected. The DISC is not doing any sales. Doesn't have any employees or office or anything like that. It's typically just receiving that commission just for being set up properly as an IC DISC and having the capability of being a commission agent to help you with your qualified sales. But again, it does not have to do anything in order to receive the commission, all the commission amounts that we're talking about today. So this is our flow through sort of example, the way that most flow through DISCs are set up. But we want to briefly talk about what about if you're not a flow through company, or what about if you don't want the DISC dividend to go to the owners in proportion to their ownership interest in the corp or the partnership. Well, then we have another structure that can be used, and so we commonly refer to as a brother-sister scenario. As you can see, the DISC is not a subsidiary of the operating company, but it's brother-sister to the operating company here. Would have same or common ownership. Doesn't have to be exactly identical. In this example, it is identical. But the key difference here is the ultimate owners of the DISC are also the owners of the related company that has the export sales. So why this structure? Well, for a C Corp, we have to use this structure. A subsidiary IC disc would do us no good. We would not get any savings because of the DRD rules. So there would be no arbitrage like we discussed on the subsidiary disc slide between the red and green arrows. We would still pay deductible commission to the IC disc. The IC disc would receive it tax-free, but it's going to pay out to the individual owners. So the benefits here are, if obviously we have a deductible dividend versus a dividend that's taxed twice, if we want to get ownership out to if we want to get dividends out to the owners, post-tax dividends, but now they're deductible, so that's a tremendous savings. And the other thing would be substituting just dividends to the extent possible for discretionary bonuses. So imagine the C Corp, has discretionary bonus that they want to get to the owner that's the CEO. Typically they would just pay a deductible bonus, but the owner is going to be taxed at individual rates. Whereas if they pay as much as they can of that bonus through the IC disc, it's still deductible to the company, and you save a couple points probably on the withholding, but it's deductible just like a bonus would be with our red arrow here. But then the individual is getting taxed at the dividend rates instead of ordinary rates. So tremendous savings there as well for the C Corps. Other reasons we would use this brother-sister structure, even though we're a flow-through entity, might be succession planning. We would just want to, tilt the amount of disc dividends to, certain family members in the case of a family-owned company. So that's another reason we might want to have a disc or disc with the varying ownership and using this brother-sister structure. Because the one thing with the subsidiary structure is you're certainly locked into the dividends being split in proportion to the ownership. Whereas with the brother-sister structure, you can use a partnership here to manage the disc dividends in between, or you can set up multiple discs with different ownerships and sort of split your disc commission between those. Moving along with our quicker review, as the assumption is that most folks are familiar. We don't want to limit, sales to exports. The natural question to ask is how much do you export when you're talking about an IC disc? But we, certainly there are sales that qualify that are not explicitly exported. Current disc beneficiaries, and this will be a big part of today's focus, can often benefit from more detailed calculation. Again, there's probably 100 plus articles written by some very well-credentialed people that claim that 50% of your qualified net income or 4% of your export sales is the maximum amount of disc commission you could take. I like to really think of those more as the basic amounts of disc commission, and that's what we'll focus on today. Again, companies got to be privately held to receive permanent benefits. A few misconceptions that we'll talk about. The second last one is, again, today's focus. There's a thought out there sometimes that $10 million is the maximum amount of qualified sales a company can have. That's not true. There's no maximum amount of export sales to be qualified. Quarterly calculations, not only are they not required, they're completely invalid and generally just a way to generate fees from what we've seen. To be honest, there's no validity to those calculations. Taxpayer must manufacture the products. Products not true. They do have to have some level of U.S. production, but certainly you don't have to be the one manufacturing. For some reason, probably because of the separate entity, structure of the disc seems to be often lumped in. When I meet folks, they'll say this is kind of like a captive insurance or things like that. There are some aggressive plays with the IC disc, but the basic use of the disc is a government incentive. So it's the furthest thing from a list tax shelter or an aggressive transactions recommended by the Department of Commerce, and perfectly good government incentive that they want you to use if you've got products used abroad. Generally there's no disruption or administrative burden with discs. Really, it's all the disc does is receive a commission and pay a dividend back. Certainly it's able to do more, but probably 99+% of discs just operate as, again, what we call a commission disc, which just receives this commission for doing nothing but being a disc and paying a dividend right back. There's no invoicing, customer's office, etc. So yeah, and then cash flow impact. I do want to talk about this quickly. Folks sometimes we meet with will say, well, we've got a lot of, you know, commission that we could come up with, but we just don't have the cash to part with it. Well, there is no parting with the cash. It doesn't have to sit in the disk for any period of time. And also, let's say you have 500,000 that you need to move back and forth, like in our earlier example, you could do that with 5 payments of 100,000, 10 payments of 50,000. I mean, they literally just click money to the disk and the very next second, click it right back. So cash flow impact is not a reason to not do a disk. There's no limitation, and probably among the list of the dumbest reasons why people have skipped these tax savings is someone told them that they've got to part with the money and have it sit in the disk. Okay, so we'll review qualification and how this ties into manufacturing specifically. So again, apologies to folks that were on the more basic course yesterday that focused on overlooked opportunities with the disk and qualification. We are going to talk about it today, but more in terms of trying to sync it with things that for manufacturers and distributors can lead to an increased commission as opposed to just discovering that items qualified. So for tangible property to qualify, we'll review this list from yesterday again. There's got to be expected use outside the U.S. So again, there's no exporting that you have to do, but there does have to be use expected outside the U.S. of the product, use or consumption or disposition expected outside the U.S. No more than 50% of the sales price, not the cost, but the sales price can be foreign content. So fairly easy to measure test here in general. If you sell something for $1, no more than 50 cents of raw, unadulterated foreign content is allowed. Foreign articles, actually, the way the regulations term it, they're permitted to be in the cost of that product that you sell for $1. So knowing these first two tests, we would think that, geez, we could just import, something from China for $1, wholly made in China, sell it for $3, and, export it to Canada. And, we've only got 30% foreign content, and we know it's going to be used outside the U.S., so we can just sell it as is. Congress did want to encourage more than just, importing things, marking them up, and exporting. They wanted there to be some level of U.S. production, or at least packaging and labeling things like that in the U.S. Reasonable people could argue on what constitutes something being partially substantially transformed in the U.S. So the second sentence here is a neat safe harbor that they offer, which tells us that 20%, if 20% or more of the cost of goods sold are attributable to U.S. labor and factory burden, you automatically pass this test. So again, this one is based on your end cost of goods sold, but if 20% of that is attributable to U.S. labor and factory burden, automatically passes the test. Very similar to the test we had for the DPAD deduction that was phased out recently, but with DPAD, it had to be done by the taxpayer, whereas here, it's much more beneficial. There's no by the taxpayer requirement if you use this safe harbor. The other thing is, packaging and light assembly alone can be enough to get you over this hurdle. So if you've got something that costs you $10, it's foreign made, but if you put, $3 of labor per unit into the packaging and the assembly and the boxing up of the product, then that would be enough. The total of 10, let's say your cost of goods sold is, you'd have, 30% attributable to U.S. labor related to the packaging. So the fact that it's just packaging alone doesn't preclude it from qualifying if we meet that mathematical safe harbor. And lastly, if the product's further manufactured by another party inside the U.S. before leaving, it can't qualify. So if I sell a finished product to Ivan and he exports it, we're both generally going to be eligible for the disc benefit. However, if I sell, say, raw metal to Ivan and he melts it down and turns it into nuts and bolts, completely changes the character and form of it, and then exports it, he will be eligible to qualify, but I won't, because my product's been further manufactured inside the U.S. by another party. So basically, this rule is telling us it's the last manufacturer and any subsequent distributors, assemblers that can qualify. All right, so let's take a little bit of a closer look at these tests than we did yesterday so that we can focus on ways that we can kind of increase the savings or increase the amount of eligible sales here. So how can we establish delivery outside the United States? Well, obviously, if we've got a bill of lading or a receipt to an export customer, those are some of the things that are specifically allowed in the regulations to prove that you've met that expected delivery and expected use outside the United States. But freight forwarder delivery, agent certification also works, a shipper's export declaration, customs documentation, but any other proof, including the nature of the property or the transaction, can also be enough to qualify here for this test number one, our expected use and delivery outside the U.S. So we have a number of clients that send component parts to places like Laredo, Texas, where there's custom shipping point. Those warehouses are solely to go for the products to then go further, leave the United States after they've cleared customs. Also, the nature of the property, if we've got some sort of equipment that is, we know it's being added to a kit, and then the kit's being exported, and we have that, information from the ultimate seller. That's a simple email talking about the destination of the property has been held to be enough, as well as just, again, nature of the property. Maybe it's printed with some obscure language, and we know or it's going through a distributor that we know only services or certain parts of the world. So all those can qualify. So it's worth a little bit of a closer look and not just saying, hey, what's an literal export sale for us? We want to focus on, are we selling cheese to Kraft but shipping it to Buffalo, New York, though we know that cheese is going to end up going from Buffalo, New York to serve the Canadian market. Those kind of things we want to make sure we capture to maximize just the amount of eligible sales that we have. Second test we talked about, going back a second, our foreign content prohibition, right? This was, again, if we sell something for $1, we're only allowed 50 cents of foreign articles in the item. So a closer look for this foreign content provision. Well, what is it? What is that 50 cents? Well, it's the dutiable imported value upon importation to the U.S. So if there's any shipping in the U.S., that you wouldn't have to include that landed cost. Again, it's upon importation to the U.S. And then one thing we want to caution people on, just because you're purchasing from a U.S. distributor, we don't feel that makes it automatically U.S. content. If it's still, foreign made item or article that you're purchasing from U.S. distributor, again, that doesn't magically make it U.S. content. There are some that believe that, and there are even some position papers out on there, but I would tread very carefully on that. Certainly, we don't agree with that. And the regulations do provide for substantially similar treatment on these items if you have them coming from different sources, but you measure certain ones. So as far as complying with this test, the first thing that we would say as far as a practical tip here is look at the items that end up outside the U.S., i.e. that you think are passing test number one, and if your overall material cost of goods sold for the item or for the transaction does not even exceed 50% of the sales price, then we don't really care whether the item was foreign made or not for purposes of the disc, right? So anything where total material COGS doesn't even reach 50% of the sales price, we don't have to do any further research. I think most manufacturers, large ticket items, small ticket items, even if it's smaller, transactions, have some idea of what their at least standard costing is on items, and hopefully can identify materials easy enough to be able to take advantage of this sort of first layer, trying to pass this test. And then things that where it might exceed 50%, of course, then you can look closer and look at the different articles that comprise what you're having your cost of goods sold. All right, test number 3, at least partial U.S. production or processing, growth, or extraction in the United States. So again, the big misconception we see here, and I would say a way to, again, maximize the eligibility or the amount of eligible sales you have here, is to please be aware that this activity does not have to be performed by the taxpayer. Under DPAD, we had almost an identical safe harbor, but it was by the taxpayer. If you use the safe harbor, it was required that 20% or more of your cost of goods sold were attributable to U.S. labor and factory burden, but that had to be borne by the taxpayer. No such requirement here. So again, in my example with Ivan, I make something in Ohio, I sell it to Ivan, the distributor in New York. He doesn't do anything to it, and it just boxes it up maybe, or throws it in as part of a kit and exports it. He is certainly also eligible to claim the benefits as long as there's partial production in the U.S. He does not have to be the one doing it. As we alluded to earlier, packaging, light assembly costs are specifically included if you're using the safe harbor. So again, we have a lot of folks that import wholly foreign produced items. The only thing that's done in the U.S. is emblazoning or packaging or labeling. One of our very enthusiastic client references are the folks who engineered and make the caps for NFL football players, those sort of rubber beehive looking concussion prevention caps that they wear in practice, the NFL, and now they're, I believe, being used in the NHL, all kinds of intercollegiate sports. But point being, those are, while produced outside the United States, the labeling and packaging and all that stuff is done in Atlanta, Georgia, and with U.S. labor rates where there are, it doesn't take much of an allocation there to get those to qualify. So there's many other examples like that where packaging or emblazoning, things like that alone are enough to meet that safe harbor. So we definitely want to make sure we include all of that. And one thing I would say is on the DPAD, while the rule was similar but less forgiving because it required had that by the taxpayer requirement, practical tip there I would say is, if your company or your client did qualify for DPAD through 2018, that's the if facts and circumstances are similar, that you could probably a pretty good bet that they're going to meet this test as well for IC disc purposes, or test number 3. So if they properly were qualified, I guess is the key there for Section 199. And lastly, the further manufacturing prohibition, so basic test number 4, that we have to meet all 4. So again, this is what I said, we could kind of boil this down to make it say the last manufacturer and any subsequent distributors can qualify. Excuse me. However, if there is further manufacturing inside the U.S. by another party before it leaves the U.S., it's generally going to make that first party ineligible. So looking at this a little closer, and from a manufacturing and distribution perspective and standpoint of trying to increase what we have that's eligible, or make sure we capture everything that's eligible, if there's simply a service being provided, that's the test can still be met. So the product has to be really substantially transformed by that other party in order to make the first party ineligible. We don't want to confuse this, with component products that are further manufactured outside the United States. That's generally going to still qualify, and we will look at one of our examples to specifically try to bring that home. That's not going to disqualify the property in general if it's a component part. So again, For the manufacturer inside the U.S., generally bad. For the manufacturer outside the U.S., can very well, may still be okay as far as meeting this this test number 4. So we want to be careful on throwing out the baby with the bathwater, I guess. Here, it's not the further manufacturing itself that's bad. It's does it occur in the U.S. or does it occur outside the U.S. that we want to take a close look at. Just very quickly, we'll talk about services. People often ask, what about services, as opposed to hard products? Again, today's focus is manufacturing and distribution, but we'll just real quickly say that for services, there are 2 types that qualify. The second one is related services. So this is, I manufacture a tractor and I export it to Belgium. I qualify the tractor for IC-DISC purposes, but I also have installation or warranty and things like that. Those subject to certain limitations can qualify as well. So those are what we call related or related and subsidiary services. So that's one category. And the other category is architectural or engineering services. And again, these are very, very taxpayer friendly. All the rules that we have are sort of 4 basic tests here for tangible property that we keep referring back to. You can throw those out the window. For architectural engineering services, we just need these 2 prongs to be met. It's got to be architectural engineering in nature, and it's got to be related to a proposed or actual foreign construction project. So you could have a domestic customer, but that's putting up a factory in Mexico. You can use labor from Mexico, from the U.S., any combination. You don't ever have to leave where you're doing the work from, or you could. Doesn't matter. As long as these 2 things are true, then the income from that activity is going to be eligible to generate a DISC commission. Okay, well, so we had a bunch of these yesterday, I think 9 or 10 sort of overlooked examples. I'm just going to refresh a few of them with a little different commentary here because they're germane to our manufacturing and distribution and increasing benefits part of the presentation here that we're going to get into that mathematical maximization or optimization, if you will, in a minute. So we'll go through these real quick. This one we've already really alluded to. It's got to be expected use outside the U.S., but in general, manufacturer and distributor are both going to be eligible as long as they're unrelated parties. So people ask, isn't that double dipping? And the answer is no. And the reason is that, ultimately it's the taxable income of those independent parties that's going to determine their IC-DISC commission. So no double dipping there, certainly allowed to do that. Also on distributor sales, we want to point out that, whether you consider it identifying overlooked sales or just maximizing sales that you already have, we want to be sure that we look to, I guess, formerly NAFTA. We need to update this slide to be the USMCA, the NAFTA 2 agreement, if you will. But point being, oftentimes that information on the country of manufacture is included, with products that are sold through distributors. They may just not have had occasion to utilize that information. And then lastly, component parts, because this is such a frequently overlooked scenario that we see. We had it on yesterday's presentation, but we've gotten a little bit more detail here. So again, we don't need a foreign customer. We don't need a shipment to a foreign location. We don't need exporting in order to have eligibility for the IC-DISC. And specifically for component parts where there's taxpayer-friendly regulations on components that you're manufacturing or distributing or both, the product might even be allowed to return to the U.S. after it's incorporated into another product abroad, again, as long as it's outside the United States. For the manufacturing inside the U.S., generally bad. Outside the U.S., probably okay. So in this example, a U.S. company makes automotive carpet. Domestically, they're selling it to Ford Motor. They request the carpet to be shipped to Laredo, Texas, and we know that it's going to be installed into cars in Mexico. We also know that the cars, many of them will come back to the U.S. for use. The cars will come back after the carpet's been installed. So here, even though we have shipment to a domestic location and we have a number of the cars returning, but if the carpet maker is not advised of the amount of cars that come back, if they're not party to an agreement, maybe for warranty purposes that tells them the amount that are coming back, they are eligible to claim all of those items as eligible for the IC disc. Now, if they are advised, as we have in green here in the second part, if they are advised the portion that come back, then of course they're only allowed to qualify those that did not come back to the U.S. So that's something that we want to definitely be aware of, is that as a manufacturer of component parts specifically, maximizing your eligible pool can take a closer look at this type of activity. We'll get into now, this maximization that we keep talking about, the 4% versus 50% not being the maximum amount of disc commission. But again, I like to think of it as really a basic, a couple of basic safe harbors, and you can certainly get commissions much larger than those amounts using these other methods. So a transaction by transaction optimization, what do we mean? We mean calculating the IC disc commission at a transactional level rather than just aggregating all of your export sales, all of your export costs. And again, when I say export, I mean qualified sales, whether they're truly exports or not. Aggregating all those and determining what's better, 4% of the qualified sale amount or 50% of the qualified taxable income. So when we do this on a transaction by transaction basis, we can not only for each transaction use either of those two methods, we can use a whole host of other methods that are prescribed in the regulations and the compliance that allow us to get a larger disc commission and encourage us to get a larger disc commission. Word to the wise, I would say that if you're doing these type of sophisticated calculations, well, they can increase the benefit significantly, but there also is some additional compliance that's needed, which should not be an issue if you're working with the right system or folks that have the right system that produces this compliance. But be careful with shortcuts on the compliance. I would liken that to sort of taking a home mortgage deduction on your 1040, but just deciding to skip the Schedule A. Not wise. So there's various different intended methods. Sorry, we were sort of a comma there, I guess. Intended, allowable, and encouraged methods per the regulations that can be used to calculate commissions by transactions. So the fact that you use one method for one transaction doesn't mean that you can't use a different method for another transaction, even of the same property, even of the same product within the same year. And then you're not making any sort of election. This is not an accounting method of any sort. This is not, so you can use those different methods, not only within a given year for different transactions, but, it has no effect on your ability to have all of the methods available for your transactions in following years. So there's nothing that precludes you or locks you into doing anything because of the fact that you use certain methods in one year versus another. Okay, so this form here that we'll look at parts of here just kind of gives us, people say, well, geez, I've attached this Schedule P when I've done an IC disc in the past. And again, with this mandatory schedule is it gets attached to the 1120 IC disc, which is basically a informational tax return, right? Because the disc is generally a tax exempt entity unless you blow some of the rules or blow your IC disc status. But when you attach this Schedule P, most folks are checking this box on the top that says group of transactions, and they are probably just submitting one Form Schedule P. Well, what does Form Schedule P do? As we see here at the beginning of it, we report our gross receipts from either the transaction or the group. And again, the group, most people will take the entire IC disc, so all of the qualified sales that are generating commission, report the total amount of sales that the related operating company will have on line 1, the related cost of goods sold and expenses on the line 2A through 2E, and come up with what we call combined taxable income, or taxable income from your qualified activity. And then later on in the form, we go here to slide 25. We've excerpted some of this, but we've got this 50-50 combined taxable income method. So that will allow you to take 50% of the taxable income you calculated. Or we said 4% of gross receipts. So the 4% of the sales on the transactions. But again, that's limited to 100% of taxable income. So I would say 99% of DISC returns that are filed, there's one form Schedule P, and either this 50-50 method is selected, again, 50% of the export taxable income or qualified taxable income, or 4% of the gross receipts is chosen as the commission. But if you look on page 1 of this Schedule P, or the top of the Schedule P, there's this option single transaction. And so this allows you to look transaction by transaction and determine mathematically which of these, all the different methods that I allude to, come up with the best commission, or the optimal commission, not just the 4% or the 50% method. So this section here, which I sort of excerpted, is the top of the Schedule P, and skip down to the bottom of page 1 or middle of page 1. Most DISC returns that you see, this section A2, if marginal costing is used, is going to be skipped because, again, folks are only aware of, or they're only choosing to utilize, they only know how to utilize the 50-50 method or the 4% gross receipts method. But marginal costing is what we're going to talk about, and that's where the advanced methods that allow you to get much more of the commission, if you choose to, calculate at the transactional level, choose a single transaction method, that's where this marginal costing comes in. Before we get into marginal costing and how that increased the benefits, we want to just say at a high level that oftentimes, especially for manufacturers and distributors, the data that's needed for these calculations is readily available, easily obtainable. The more sophisticated your sales and cost systems are, whether it's job costing, whether it's standard costing, just-in-time cost, the easier it's going to be to get the extracts that are needed to calculate taxable income by transaction. We can go back to prior years. If you have a DISC in place, you're generally limited to double the DISC commission that was originally calculated. I won't get into the technical reasons why, but if you already have a DISC in place, already filed a DISC return, it is something that you can go back to look at with a transaction by transaction calculation, and oftentimes significantly higher than the basic benefits. Okay, so marginal costing, which is again referred to right on page 1 of the Schedule P in this section that everyone skips and says, "What the heck is this thing, marginal costing?" That's the main feature of doing a T by T or transaction by transaction optimization. Specifically allowed and encouraged in the DISC regulations. As you can see, it's present in the compliance. The crux of marginal costing is that less profitable transactions of a product are permitted to generate a DISC commission as if they're as profitable as the average profitability for that product, or for the product line or the segment. You have a lot of different choices. However, transactions that are more profitable than the average, they don't have to sort of calculate as if they're less profitable. They can still enjoy a commission that's calculated based on the actual profitability of that transaction. So really what it is, it's a encouraged and authorized cherry picking of different methods to use to see which method on which transaction gives you the ability to get the highest commission. So sort of bizarro world, in terms of a lot of tax benefits that we look at, they're trying to encourage you to sort of break through the ceiling that would otherwise be there with basic calculation methods. But I'd say the thing it's most analogous to is probably taking itemized deductions versus a standard deduction. When your itemized deductions get you a better answer. Certainly there's a little bit more compliance and reporting. Schedule A, reporting your charitables if they exceed a certain amount, but it is certainly something the government, intends and wants you to do. what's the congressional intent for that? It's simply to reward qualified activity that's not as profitable as the average activity. So to give you a little bit of a boost in cases where you may be exporting products or selling products for foreign use, even though they're less profitable than what the average, what the average sale of that product would be. When we say the average, we mean the average worldwide profitability for either the product or product line, product group, whatever level you choose to calculate this. So we'll look at an example of marginal costing to show you one of the methods and how it can increase this commission. But one thing I do want to point out is that it's not just looking at, when we say as if profitability here, as if the transaction is as profitable as the average worldwide profitability, you have your choice of substituting the actual profitability. So something makes 8%, but it belongs to a product line that is very profitable that makes 30%. The product segment might make 20%. You have your choice of actually substituting the profit percentage that you want for the actual profit percentage with, various different profit percentages, or what we call worldwide profitability or overall profit percentages. So how do we maximize those choices? Well, let's say we're looking, this is, a conceptual example of what we call a product tree or a product hierarchy. Many of your companies or clients probably have this in place, likely more than eight different unique products, but the first level would sort of be your most unique physical differentiated level of product. So your SKU or item number that's physically distinct. And in this example, there's 8 of them. But as you can see, the first two, the erasable pen and the standard pen, they map into a product line of pens and pencils product line. The first 2 items, they map into writing instruments. So the point being, the deeper or more levels that you have in this product hierarchy, the more options of attractive as if profitabilities you have to substitute for the actual profitability when you're going to calculate your disc commission. Again, these often exist at many companies that are taking advantage of transactional calculations, or that should be. They'll have the sort of, their product codes, SKUs, whatever, mapped into their, basically a product tree or hierarchy that generally exists. And you want to have, more of these levels calculated so that you can look at these various different percentages. So I know that's a lot of conceptual math thrown at you there. So let's try to bring it home with an example here. So this is just a partial transactional optimization. So this is just actually one of the many available methods that we have, along with the basic methods that we're going to look at in this example here. So let's say we have a couple of transactions, standard pens that are sold for use outside the United States. We happen to have 1,000 units, or $1,000 of sales in the first transaction, $1,000 of sales in the second transaction. Both of these are exported, let's assume. The first transaction has net income of $300. The second transaction only has net income of $90. So these are the actual profitabilities of these transactions. Sales less our cost of goods sold, less properly apportioned expenses. So, we've got this sort of variability where this transaction, why? Maybe it's the time of year, maybe it's back to school time. And then we're able to, it takes less unit to comprise that $1,000 of sales. But the point being, we in this case, we're able to get our standard pen. We're able to demand 30% in this transaction, 9% in this transaction. Here's on the right here, our disc computation method. So we'll come back to that in a minute, but you can see there's the 4% method, the 50% method, and then just one marginal costing method that we've chosen to use in this example here. So before we get into calculating those different methods, let's take a look at our worldwide sales. And this is that our product hierarchy. Remember, we talked about standard pens, then those are pens, which flow into writing instruments, office supplies, so on supplies. So what we're looking at here is a separate calculation just to come up with the worldwide or average profit percentage for all of these different product lines or products. So for standard pens specifically, that would be the product level. 10% is our worldwide profitability average. Again, this includes domestic and export sales. This is total blended overall. So we make 10% on standard pens. The product line of pens in general, we make 15%. Office supplies, the top level, we only make 5%. So maybe this is the company-wide, profitability is 5%. However, writing instruments, we are actually making 20% on. So this includes the pens and also pencils, anything else that'd be in the writing instruments. So 20% is a nice, attractive profit percentage, right? Of all these different profit percentages in this column, B over A, worldwide profit percentage, 20% is the best one. So let's keep that in mind when we do our calculation of how much commission we're entitled to on these two transactions that we've isolated. Well, on the first one, if we take 4% of 1,000, we get 40, limited to the net income, which is 300. So our answer is 40 for the 4% method. If we use the 50% method, we're allowed to take 50% of the actual net income on this transaction. 50% of 300 is 150, circled in green there. What about marginal costing? Well, if we pick the best profit percentage here, is 20% from our chart above with our average profitabilities, we're allowed to pretend, if you will, that our profit percentage is 20% instead of 30. So our as if taxable income would be 20% of 1,000, and 50% of that 200 amount would be 100. So we're not going to use marginal costing here. We're going to stick with 150 because the transaction is nice and profitable. On the second transaction, where we only make 9%, let's go through our iterations here. 4% of 1,000, still 40. 50% of the net income on this transaction, so 50% of 90 is 45. However, when we can choose these different profit percentages and we choose the 20%, well, if we made 20% on this $1,000 sales, again, our income would be $200 and our commission would be 50% of that. So 50% would be of the as if profitability is 100. And you can follow the algebra there. And there are some other limitations that do apply, but in general, this is exactly how this is going to work. So each of these transactions is going to require a separate Schedule P, the form that we looked at earlier. But now that section A2 here that everyone leaves blank is not going to be blank. It's going to calculate using, on line 10 here, overall profit percentage. We're going to throw in our 20% there because we are choosing to utilize this profit percentage of 20% from the product group that this pen belongs to. So again, the method that one transaction chooses has no effect on the method that the next transaction chooses. So as you can imagine, when you've got transactions with different profitability and all kinds of different product groups and product lines, the more of these you have, the more opportunity there is to take advantage of marginal costing. Let's dispel a couple of myths here. So this 1120 IC Disc Schedule P, it's a required attachment for every group or transaction which a commission is calculated at. So again, if you just lump everything together and say we're going to take 4% of our qualified sales, certainly you just need one Schedule P and you need to make sure that you meet the limitation, and that's all you need. If you've got 1,000 transactions and you calculate everything at the transactional level to maximize the calculation, you need 1,000 form Schedule Ps. Got 1 million, you need 1 million form Schedule Ps. We see some in the practice in this area is trying to do some sort of summaries or schedules, summary schedules. There were some schedules that were still pretty sophisticated that were allowed for earlier export incentives, but again, this would be akin to filing a, making up your own Schedule A or putting in a, your own schedule to report your charitables and your mortgage deductions if you want to itemize. So not recommended. So the key to that transaction, right, and the key to these transactions and getting more benefit was the variability in profitability, because we had some products made 9%, some transactions, that make 9%, some that make 30%. So variability is the key. And oftentimes when we talk to businesses that are using this and might be able to take advantage of this, the answer is, well, we really don't have that kind of drastic profitability. So, we don't have that kind of variability like you're showing us in the example between the 30% and the 9%. But remember, this is net taxable income variability that we're talking about. So it's not just gross margin that can cause this type of variability. So what are some of the reasons that we find oftentimes causing this unintended variability that ends up benefiting us on a DISC calculation? Probably the most common one is material cost fluctuations. And the more sophisticated we're getting in tracking those, the better we are in being able to capture those. Second, the way we apportion, expenses. That's another one. For many types of expenses, you're able to apportion based on facts and circumstances. And so it may not just be a smooth pro rata apportionment to all transactions. Outside expenses like shipping and distributor commissions often will cause variability, especially for our products that are qualified, right? We may need to pay someone to handle the compliance, the distributor commission, and we might have to eat the shipping on export products. So sometimes that makes a lot of them less profitable than the worldwide average for the products if we look at the domestic ones as well. Depreciation and associated tax adjustments. It's another big one where we see causing a lot of variability. So we'll look at these a little bit closer. Material cost fluctuations. Many of our clients where we just had a standard cost in the past, now they have sort of a just-in-time, if you will, costing systems that are for transactions different part of the year. They're capturing those fluctuations in costs, again, intended or not intended. Expense allocations. Again, there are some categories where we're required to use a broad bases like sales, gross margin, or cost of goods sold, but many categories we can allocate on a portion based on facts and circumstances. So that might result again in something that's fairly uneven in terms of our profitability. Depreciation. So this is a big one that we see often, especially with bonus depreciation, accelerated depreciation, cost segs, and 179D and all that good stuff. Accelerated depreciation, oftentimes it happens, from a tax adjustment standpoint, it's related to an event or property that's placed in service, at a certain point in the year. Oftentimes it's late in the year. And oftentimes it's, only related to production of certain products. So again, we will have very large book to tax adjustments that will lower taxable income, but they may be only applicable to transactions that occur, say, after November 1st of a given year, because that's when the property was put into place, and they only may be production for certain product lines. So we can have a very sizable tax adjustment lowering taxable income that only gets allocated to specific transactions and specific products that happen in a certain part of the year. Well, what's that going to do? That's going to create this type of thing, typically, where you've got variability, where you might have products making 9% or 0 or -10, and other transactions get a lot more profitable just because they didn't have to absorb this depreciation tax adjustment. So that's another items that we see that swings things a lot. So the big takeaway here is that it's not just gross margin that causes variability and profitability. It's all these different items. And when you do a transactional calculation, it's not just extracting the sales and material costs. It's allocating costs that aren't captured in your system. Maybe there's certain labor that's not absorbed in there, and of course all these items that we're talking about that cause variability in profitability. So these computations again can be very sophisticated, a lot of compliance, as we talked about in terms of the number of compliance forms that you might need. But if you're working with good systems and software, then that's something that should be produced as part of that, the proper compliance. The increases can be significant. This is just a very high level one-page summary report of a calculation that we also had up for a moment yesterday. But in this example, you can see down in red below, if we just looked at all of the export activity, which is this total line here on the bottom, export sales of 41 million, taxable income is very slim, only $250,000, largely because of a big book-to-tax depreciation like we were just looking at in our variability slides. But point being, we ended up, even though the income was only 250,000 here that we see in the CTI column, the total row. So our basic methods would yield us either 125 of disc commission or 250,000 of disc commission using the 4% method, but using the transactional calculation and using all the allowable methods. In this case, the optimal result was just about $1 million higher, more than $1 million of commission higher. I want to talk a little bit about some aggressive structures and just finish up with these, just because they're out there and there's some misunderstanding on these, largely I think because of the way that these are presented by some providers. So the Roth IRA IC disc structure, what this essentially does is it circumvents the Roth IRA contribution limit. So I don't think this is anything that was intended. I think everyone would agree, but this is one of those form over substance things where the courts have essentially, in numerous circuits, have told the IRS that, look, if you want a change in how these vehicles can be used, namely the Roth and the IC disc, to tax savings incentives vehicles, then change the law. Don't rely on the courts to interpret this. So this is something we'll look at the structure here for a second and talk about it. But this is certainly something that's not an intended benefit, but it's out there. But having said that, it's not an intended benefit, but it can be a tremendous savings. And again, until the law is changed, it may be out there. The second one we'll look at for a moment is the inbound IC disc structure, very common in manufacturing and distribution. So, the disc regulations are very clear. They tell us that, I'm going to go way back to our structure slides here. They go way back to telling us that, if we've got a disc dividend that reaches an individual owner that is either a foreign individual or a foreign company, that this dividend is going to be taxed at the maximum tax rates as effectively connected income at the highest ordinary rates that are out there. Very clear in the disc regulations. This position, which again is often marketed as, oh, this is what the IRS intended, it's the furthest thing from. This position basically says that it relies on the sort of later in time theory and says that, look, the disc regulations may state that, however, we have treaties with different countries, and if the treaties tell us that all dividends are taxed at 5% withholding rate or 0% or whatever the case may be, then from a U.S. taxation standpoint, that's it. That's all there is in terms of the taxation. So what the position is saying is that instead of being taxed at the maximum ECI rates at the maximum ordinary rates, we can tax this at the dividend rate tax it at the treaty rate for dividends based on the treaty with the country in question. So, this is one where, again, we see it in manufacturing a lot because we'll have a foreign owner that will, be having a wholly owned company in the U.S. It's going to be a C corp for U.S. purposes, so it's going to pay this brother sister disc commission, which there's certainly no rule against. Certainly no rule against the disc paying the dividend to the foreign owner. It's just that the regulation tells us that it's taxed at ECI rates, whereas this position tells us that this is to be taxed at the treaty rate. So again, this is just something you want to be aware of. It's not prescribed in the disc regulations. It's a position. Very well, maybe technically correct, but it's certainly not intended. In this structure, we've got a disc that receives the commission as a normal, pays a C corp holdco, so an entity subject to tax. You might notice, which then fuels the Roth and circumvents the Roth limit, so you get a permanent benefit as well as this tax-free growth here. So again, the Roth is another one that the IRS keeps losing in court, but certainly not an intended benefit. Courts keep saying change the law. The update here, I would say, on both of these, is that the Build Back Better Act, which really didn't go anywhere, but the original legislative text basically said, paraphrasing here, discs are okay, but we really don't like the Roth IC disc structure and the inbound disc structure, so we would like to see changes about that. So it is certainly on the radar, if you will, of the Joint Committee and the IRS, and I guess the administration we have for a little bit longer here. We'll see how that pans out. I don't expect much in the way of change, at least for the next 4 years. So yeah, that's all we have for you. Hopefully that was useful for folks that are looking to look at ways that they might be able to increase disc commissions, particularly for manufacturers and distributors. Thank you again, everyone, for joining us. Appreciate all of your time, and thank you again. Take care. Have a great day.